Well, good morning. Happy Thursday. Megan and I are working both out of our homes. She's doing the lovely outside thing that always makes me so jealous. But we've got a ton going on. What's happening in the real estate market is we're all kind of feeling the slowdown. We know that summer is winding up to an end, although it's scorching hot outside right now. You would know that. But with school starting, home sales, what did they do in August? And that's what we're going to be talking about. The calendar just turned. Happy September. We're going to be talking about a little of the things that are going on in the economics and this whole term of a housing recession and what does that mean. So before we get started, we'll always do our quotes. Megan and I were talking before we got started. I've had a lot of change in my life in the last week. If you saw the live yesterday, you got wind of it. But last week I said a quote and I shared that quote and I didn't know what was coming. It said, don't wait for opportunity, create it. And then today's quote, I want to start it off with, we must simply decide, this is what I believe. This is who I am going to become. And I am willing to put it all on the line to achieve it. And that was a quote by Nick Lavery, who is a military vet who has lost a leg and gone back to serve with only one leg. And we decide. That's the thing, is we decide. So just as a comment, I'm not going to dwell here, but I personally have moved to OneTrust Home Loans. I'm very excited about that. My team is supporting the Fairway buyers that we have in our pipeline that I know that we've committed to your closing date. Fairway is coming around behind us and surrounding my team as they are performing and being able to support those clients. So we will be reaching out to everybody. We are very excited about the opportunities that we have with the technology, with the recruiting capability, and with some of the other opportunities, which I will be expanding on next week. But for this week, I want to jump in. Miss Megan, how are you doing this morning?
I'm good. It was nuts. It was nuts this morning. It's been a really busy week. So I've had the kids the entire week this week. And everyone was so tired last night, they didn't want to shower before bedtime. So I said, great, we'll wake up early and we'll shower in the morning before school. Well, everyone was too tired to get up and shower this morning. So we went with stinky kids to school today, and I was stinky up until about 20 minutes ago, where it was like, I can't even get in the shower because I'm trying to wrangle kids. And so it's been kind of a chaotic morning trying to get everyone up and out the door. We had one person post and say that they were having some audio issues. We're not having anyone else report audio issues. So check your speakers and make sure those are working. Everything looks good on our end. But if you continue to have problems, let us know and we'll see if there's something on our end that is going wrong. But we haven't had anyone else pop up and say that there are any audio issues. I went through and put together the stats for last week yesterday morning while I was sitting on my back patio, as I typically do, and had my coffee and got all of the numbers out and ready to go for you. Now we're headed into Labor Day weekend, and I think that we should probably spend some time touching on going into Labor Day weekend. Labor Day weekend is one of our 3-day major holidays, and 3-day holiday weekends and religious-based holiday weekends end up having an impact in the market, and we end up seeing showing activity drop by 30 to 40% over these 3-day or religious-based holiday weekends. So going into this weekend, if you're having an open house, expect your foot traffic to be lighter. If you put up a new listing, you might not get as many showings on it as you were expecting to see. But we also see that under contracts going into a holiday weekend, they're more likely to be able to get a deal on those transactions. We end up seeing that more units that go under contract over holiday weekends have larger and more widespread price reductions. So that's kind of an interesting trend as well. So if you're in town and if you've had buyers that have been frustrated, or if they're looking for something that they have a little bit more negotiating power on, this is a great weekend to take your buyers out to get them under contract, because you'll experience significantly less competition in the marketplace as we head into Labor Day weekend. With that said, I hope that you guys enjoy your Labor Day weekend, and we'll go ahead and hop into the numbers and we'll talk about what happened last week.
And I do want to piggyback on that, because I love holiday seasons like this, where now I don't camp, I don't go out of town on Labor Day, because Lord knows you're not going to get me on I-70 or 285 on Friday or on Monday. But we are working. My team is both working to support the Fairway clients, and I'm working to build new relationships and new clients with the OneTrust. So I did put my phone number in the chat. Please reach out to me via text and phone. But do know that we are all working this weekend to make sure that you guys are supported.
Awesome. Always good to know that Nicole's on call. I will be wrangling kids all weekend, so I'll keep an eye on my phone and email, but let me know if you need me over this weekend as well. So this week, we're going to cover the week of August 24th through August 30th, just this last week, and more kids went back to school just this last week. Looking at what we're talking about for our heat map, this now goes all the way through August, and you can see that our cooling trend really started to settle in back here in May, right after Easter weekend happened. We continue to see the cooling pattern settle in as kids head back to school, and we'll see an even bigger pullback as we get past Labor Day weekend. If you're one of those agents that fires expired listings, expect there to be a big pop of expired listings today as we hit month end going into August. A lot of listings expire or withdraw at the end of the month in favor of waiting, especially in August and September, in favor of waiting to list until next spring. So if you're one of those agents that goes after those expired or withdrawn listings, you can expect there to be a big wave of new expired and withdrawn transactions coming in through this week. Based off of data from this last week, we ended up having about 6,600 available listings going into last week available for sale. Our average daily active count fell by about 1.1%, but we're still up by 84.5% from where we were 1 year ago. Pending transaction counts ended up falling by about 3.6% as kids continued to head back to school, and we're putting about 1,100 units under contract each week. Back on markets ended up spiking this last week to 290, or it was an 11.1% increase over where we were last week. So we did see a little bit more of our back on market activity. Now keep in mind that any back on market activity is from any off market status into an active status. So it could have been expired, it could have been withdrawn, or it could have been pending to go back on market again. And so about 40% of those that were back on market were under contract at one point. So our fallout rate continues to hover around 8 to 10% of units falling apart and then going back under contract. I've had a lot of people reach out and say, how should I go through and price my property if we were under contract a month ago? Should I go ahead and make a price adjustment now if we sit on the market for a little bit longer? And I say, yes, we should probably go ahead and make that price adjustment because that time on market still counts. It catches back up when you reactivate that listing. Months supply of inventory was sitting at 1.4 months worth of inventory, and it increased by 2.6% week over week. So we saw a slight increase in our month supply of inventory. So that means for every one buyer in the market, they have about 1.4 homes to choose from, allowing buyers to have more negotiating power now than certainly what we saw back here earlier this year, where we were down to 0.2 months worth of inventory. This number seems to have leveled off. We're bouncing between 1.2 to 1.4 months worth of inventory. What's likely to happen is that number will continue to grow through the end of the year by a couple of tenths of a month. And so we're not going to see a huge onslaught of new inventory making its way to market. New listings are holding relatively consistent at about 1,100 new listings hitting the market each week. That number will start to dwindle as we go into September, October, November, and December. And so oftentimes there can be this slight shift in the relationship between supply and demand as we start to see inventory fall off our books going into September. And so September usually represents the most amount of listings available per buyer in the market during any other month during the year. So September is a great month to buy in if you are a buyer that's looking to purchase in this market. You have more choices available in the month of September than you do during any other month of the year. Looking at our odds of selling, we were down to 53.4% odds of selling based off of listings that went under contract and or closed in the last week. Again, this is where I take into account all of the available listings versus those that go under contract and or close, and I project that forward for a 30-day period of time. And so that means that there's a 53.4% odds of selling in the first month that you're listed based off of data from last week. That number is definitely down from where we were at 87.3%, and it's slowly slid. And this number is likely to continue to decline as we head later into the year. So if you've been sitting on a listing and you want to get it to market, my advice to you is to get it to market as soon as you can, because the rate of buyers dropping off through October, November, and December becomes pretty apparent. And so you want to make sure that you're leveraging the largest pool of potential buyers that you can going into the later part of the year. We're still nowhere close to a market imbalance. We still only have 23.5% of a market imbalance. Keep in mind that a market imbalance includes a 6-month supply of inventory. So based off of what went under contract last week and what we had available, we only have 23.5% of the inventory required to offset demand. Now, a lot of people are looking at pricing strategies and marketing strategies by looking back to where we were in 2019. And my weekly reports don't include data that goes back to 2019, but you can look at my monthly reports for attached and detached so that you can see what those numbers were back in 2019. Back in 2019, if you recall, we also had a big influx of what our interest rate did. We went from about 3% up to 4.5%, which caused affordability issues to come to fruition. And we saw appreciation start to slow down in 2019. And so again, if you're looking to try and compare and contrast where we are now versus where we were in 2019, 2019 is a great year to go back to try and figure out, okay, now where are we in this marketplace? But we're still far from a market that's going to crash. We're too undersupplied with homes. We have too much equity in our market. And plus our job account is really good. We're within only a 3.5% unemployment rate right now. Looking at where we are for showings this last week, there were about 1,400 total showings that were set this last week, which stayed relatively flat. Again, showings are a really great leading edge indicator, and leading edge indicator going into this next weekend is that showings will likely drop off by about 30 to 40% going into next weekend. So we had 2.2 showings per property this last weekend. And so again, it's really important that you're having that conversation with your sellers, letting them know that you might not be under contract in that first weekend, that it's going to take some time to get these properties under contract. But if you put up a new listing, 2.2 showings on average for any new listing that was put up. We're now up to 13 showings to go under contract. So this could be strike two if you're trying to consider whether or not to make a price reduction. We've been talking for the last couple of weeks to slow down the rate at which you're making price reductions because our market has started to slow. We knew earlier this year that if you were making price reductions after week one, that if you had to make a price reduction or if you weren't under contract in the first 7 days, that it was likely that you were overpriced. But now it's taking weekends 2 or 3 before we're making price reductions. So slow down the rate at which you're making price reductions and watch your benchmarks. Number one is if you didn't have 2 showings last week, you may not be hitting your benchmarks for having enough bandwidth or buyer activity through that market. Or if you've had a total of 13 showings and no offers, that could be the next threshold that you need to cross in order to know if you're hitting your benchmarks or not in this particular market. So if we're getting 2.2 showings per week and it's 13 showings on average each week, you could be on the market for as long as 6 weeks, 6.5 weeks before you go under contract on your properties at this point. Median days on market stretched out by an extra 2 days as kids headed back to school in these last couple of weeks. We're now up to half of the homes are under contract in 20 days or fewer. So that could be strike 3, where if you've been on the market for longer than 20 days, that you are in the bottom half of the pack and that you may not be hitting your targets in order to know if you're priced appropriately or not. So 20 median days on market for units that went under contract last week. We saw that 49.1% of homes that went under contract last week made a price reduction, and that's been slowly increasing, and we're likely to see that number continue to increase through the end of the year based off of data going back to 2013 since we dipped into this extreme sellers market. So we're likely to see price reductions continue to increase, but 49.1% is almost half of the homes that went under contract last week made a price reduction. The price reductions continue to be substantial. We're looking at about a 6.5% price reduction right now, or about $45,000 off of an average priced home here in Metro Denver. Keep in mind that an average priced home is about $780,000 right now in greater Metro Denver. And so that's a pretty big substantial price reduction that we're looking at here in the marketplace. Now for homes that are up to $500,000, this represents roughly, yes.
Really quickly, going back 2 slides to now get back to 50% of the homes are having price reductions. I mean, yes. A 50-50 shot, that is really impactful and holding on to that bit of information when you're going in, especially talking to sellers, right? Like, we've got to nail this. We have a 50-50 shot of having a price reduction. This is game on. This minute matters. And just really kind of honing in on that. That seems really impactful.
Well, and I think that it's important that you're sharing this information with your sellers up front to set the stage for the price reduction, because now, again, it's more likely, you're almost more likely than not to be making a price reduction at this point. So it's important that you're setting the stage and letting your sellers know that, hey, we're not going to be under contract in the first weekend. It's not likely that we're going to get multiple offers like what we saw earlier this spring. You're going to spend more time on market, and the likelihood of a price reduction is increasing to go under contract each week. And so again, that's likely to continue as we go through the end of the year, and the size of the price reductions continue to go up. We're looking at about 6.5% of a price reduction right now. For homes that are up to $500,000, again, this represents about 27% of our overall inventory. This market started to cool again back here in April, right after Easter weekend, where we started to see these blue cells start to creep in, indicating that our market has become less competitive. As of right now, we're holding fast at about 0.9 months worth of inventory, and we have about 1,600 active units on the marketplace in the market right now for homes that are under $500,000. That represents a 2.5% increase in where we were week over week. And pending transactions actually increased this last week by about 5.7%. We saw 424 units go under contract. Back on markets in this price range also increased up to 18.5, or we had 109 go back on the market. Again, you can consider that about 45 of those were in previously under contract status before they came back on market. So we're looking at about a 10% fallout rate right now for units that are going under contract and then falling apart if you're trying to put yourself in a backup position. Looking at the odds of selling, we're looking at about a 64.2% odds of selling right now. That number is holding pretty fast and steady. It's continuing to slowly decline as we go through the end of the year, where we'll see the odds of selling continue to decline. We're only at 14.4% of the inventory required to offset demand for homes that are in a 6-month supply of inventory. We're still looking at about 3 shows per property per week. That declined by about 1.2% from where we were last week. And so the number of total showings where it's actually up, but our inventory was up. So the number of shows per property actually went down this last week. So if you didn't get 3 showings on your listing that was under $500,000, that could be signal number 1 that you're not hitting your benchmarks for having the price appropriate. We're still looking at about 12 showings to go under contract. So if it's 3 shows per week and 12 showings to go under contract, that means that we're looking at about 4 weeks on the market for homes that are under $500,000. Median days on market stretched out by an extra 3 days this last week, and it was 16 median days on market. So now we're looking at just over 2 weeks on market for homes that are up to $500,000, and 45% of them reduced their price. So we're starting to see more price reductions even in this under $500,000 market. The size of the price reduction actually decreased this week, where we're looking at about a 6.2% price reduction, or about $27,000, $28,000 off of the original price. For homes between 500 to $1 million, this is by far our largest price point, with 60.2% of our inventory falling into this market. You can see that the cooling trend really started to settle in as we hit Easter weekend, and the market has continued to become less competitive as we head into our fall months. Right now, we're sitting at about 1.6 months worth of inventory, which was up 7.4%, indicating that for every 1 buyer in the market, they had about 1.6 homes to choose from. Our average daily active count fell by about 2.4%, but our pending transaction count fell by about 9.1% going into this last weekend. We're still looking at about a 10% fallout rate for homes that are between $500 to $1 million right now. The odds of selling is slowly declining. We're looking at about a 50.2% odds of selling if you list this weekend and you go into the next 4-week period. So again, about half of the homes are likely to sell in that first 30-day period. We're looking at about 27.5% of a balanced market right now for inventory. And so again, we're nowhere close to a market correction that's happening in our marketplace, or anything close to a bubble that might burst. We're still looking at about 2 shows per property per week for homes between 500 to $1 million. I'm fielding probably 4 or 5 phone calls each week where they say, I put up a new listing and I didn't get any showings on it. Should I go ahead and reduce my price? And I say, no, wait. You need to wait 2 or 3 weeks before you go through and make a price reduction, because we want to make sure that we get 14 people through that house before we're making a price reduction. So if you're getting 2 shows per property per week and it's 14 showings to go under contract, you need to be prepping your sellers for about 7 weeks on market in order to sell a home right now. Median days on market stretched out to 22. So now we're looking at just over 3 weeks on market for homes between 500 to $1 million for half of the homes to go under contract. We saw more than half of the homes ended up reducing their price last week that went under contract, with 52.8% of them making price reductions. And the price reduction was about a 6.5% price reduction, or about $47,500 off of the original asking price for homes between 500 to $1 million. For homes between 1 to 1.5 million, let my slides catch up here. My computer's heating up and I'm starting to get nervous. And so looking at our heat map again, we really saw the cooling trend start to settle in as we hit April, and markets started to transition from a more competitive market to a less competitive market. We're now sitting at about 2 months worth of inventory for homes between 1 to 1.5 million. So for every 1 buyer in the market, they have about 2 homes to choose from, and that number stretched out by 4/10 of a month just this last week. Our average daily active count ended up falling by about 1%, and our pending transaction count this last week fell by about 20%. We had a much slower weekend this last weekend with only about 61 units going under contract. Back on markets, there were about 13 of them. So these homes have a lower fallout rate, where if you go under contract on a home between 1 to 1.5 million, we're looking at about 5% of those falling out. We've been holding pretty even at about a 47 to 48% odds of selling for the last 6 weeks or so. So again, you've got about a 50% chance of selling in the first month that you're listed. We still only have 22.7% of the inventory required to offset demand. We're looking at about 2 shows per property per week for homes between $1 to $1.5 million. And it's about 16 showings to go under contract. So it could take 8 weeks to get enough buyers for that property before you decide to make a price reduction. Median days on market stretched out to 4 weeks on market. We were looking at about 28 median days on market for homes between $1 to $1.5 million, and 40.4% of them ended up making a price reduction. So we saw fewer price reductions in this $1 to $1.5 million range. The price reduction this last week was pretty substantial, though. It was a 9.7% price reduction on average, or about $140,000 off of the original asking price. For homes between 1 to 1.5 to 2 million, we're talking about a very small portion of our market. We're now only talking about less than 3% of our overall market, but you saw the cooling trend also settle in as we hit Easter weekend, and the market has continued to become less competitive as time goes on. Whoops, my slides are flipping faster than I'm talking. Hold on. Month supply of inventory ended up holding relatively consistent this last week. We're holding fast at 1.9 months worth of inventory with about 200 average daily active units, and that was down by about 5.3% week over week. Pending transactions were down by about 4%. We saw back on markets, we saw 6 units come back on market this last week from an off-market status. The odds of selling is jumped up a little bit by about 8.6%. It jumped up to 49.3%. So we had some more market activity this last week in light of some inventory dropping off and a little bit more buyer demand. We're still only have 15.7% of our inventory required to offset demand. And what's interesting is that we're more upside down on our relationship between supply and demand at higher price points than we are at lower price points. So there's more significant demand at higher price points right now, where we're looking at how shallow we are on inventory. Again, we only have 15% of the inventory required to offset demand. We're looking at about 1.6 shows per property per week for homes between 1.5 to $2 million, or about 13 showings to go under contract. So again, it could be taking as long as 6 to 7 weeks before you get enough buyers through that property to decide if you're going to make a price reduction. We saw median days on market stretch out to 32, so we're just over a month on market for about half the listings between $1.5 to $2 million, significantly more time than what we were looking at earlier this year. We saw 45.5% of those homes reduce their price this last week. And so with an average price reduction of about 4.5%, we're seeing smaller price reductions at the higher end of the market, where it was about $77,000 off of their original asking price. Looks like we had one question pop up. And so Megan, for homes that list from the beginning at a price that is 5% lower than peak sales in April and May, already 40K less than those higher listings, are you still seeing larger price reductions after the time needed on market, or lower price reductions like 5%? You know what, Nina, I have not looked at that data. That's something that I'd have to go through and look at. And I'm not quite sure how I would go through and measure that to see if it's listed below that market value. I can't tell. I'd have to do a really micro market report in order to go through and try and figure out that number for you. So I'm not sure if we're seeing those same price reductions. I can tell you that if you price a home right the first time, it sells faster and for more money. And so for homes that go under contract in the first 7 days, we're still likely to get 2.5% over their original asking price and draw out those multiple offers. And for data that went under contract back in the month of, or that closed in the month of July, it was about 34% of them were getting multiple offers. Now I'm sure that number is going to go down when I pull that data on Sunday to represent what's happening on for August. And so I will we'll take a look at that. What's the percentage of the market that is 500 to a million? And so 500 to 1 million is about 60% of our overall inventory, and 1 to 1.5 million is about it's about 8% of our overall market. And so again, it starts to dwindle once we go over $1 million, where we end up seeing a lot fewer homes that fall into those particular price brackets. I think we got all of the questions. Oh, where can we find these slides? We'll be emailing everything out to you guys by about 1 o'clock this afternoon. You guys should get a copy of it. So if you registered for this webinar, you are on our mailing list until one of us dies. And so we will make sure that you guys get a copy of everything by about 1 o'clock this afternoon.
That is true. Even if it gets emailed from a different email address, it is coming.
You'll get a copy of everything.
It is coming. And then somebody also asked where we can see the recording. If you missed the first part, this is Facebook Live. So you can easily just hop over to Facebook and watch the first part. Or again, Megan and I both send out information to the entire group. Miss Megan, you left me like 4 minutes.
I did. I went through it pretty fast today. I didn't have any extra stuff to talk about. Some of the things that I'm working on is that section 4.2 of your real estate contract has come back into play for seller concessions and down payment assistance. So I've been slowly re-downloading all of the data back to 2008 so that I have a comprehensive analysis of what's happening with concessions and down payment assistance. So I'm hoping to have that done for the August report. I'm starting to get under pressure to try and get those numbers out, but that's definitely something that's coming up more often. And I want to be able to have numbers to speak to that.
That's hilarious because that's something you're probably doing in your free time.
All my free time. Single mom, 100%, the 7-day period in all my free time.
Oh my God. You guys, we love doing this. I mean, Megan and I have so much fun. It's a whole lot of work. Going back to 2008 and downloading all the data and assessing it so that she can figure out the micro trends for you for all of these new changes that are happening in the market. Takes a lot of time, and it's the passion that she loves to serve and she loves to educate. The same thing, 20 minutes of content, 30 minutes of content. The two of us are spending hours in front of our computers, making sure that we're assimilating the information in a way that not only is it useful, but that it's communicated in a way that you can then share it. So we're going to jump over to the economic side of things. I'm going to share my screen. I just appreciate the time that you spend with us every Thursday. We sure do love spending this time with you. And of course, we do it so that we earn the right to sit at your client's closing table and show you the kind of service levels that our team can have, especially as we move over to OneTrust. Not only do we have all of the standard jumbo and Fannie Freddie Direct, all of the products that I've always had, we now have portfolio products. So I work with a ton of investors and they're always asking me for things I just simply can't do. It's not in our wheelhouse. So those bridge loans, HELOC loans, fix and flip, land loans, construction loans, one-time closes are all now a possibility given the fact that they have the portfolio. So it was a different turn to be able to kind of continue to support. Ultimately, it's about supporting our clients and our realtors, given the changing market. We have to be flexible and we have to be adaptive and we have to be creative. And without being those things, we can't survive doing what we've always done. We have to be open to change, and change sucks. Change is so hard. It is not fun. And I love my Fairway family and I love the past that I had there. But it's the need to serve that we continue to do this. I know Megan has done the same thing in her past where she had to change to serve better. We make those choices. You guys make those choices. How do we step out of our comfort zone to ensure that we're growing and building something really cool? So I know Megan's been a huge supporter of everything that I've just been going through. So I thank you, Megan.
Of course, I'm your biggest fan. You're my partner in crime.
Well, all right, let's share the screen. Let's get into the economics because I know that that's something that you guys want to do as well, not just hear me talk. Let me get over to close this and share screen. Share screen. Sorry, that took me a second and I don't know why, but here we go. All right. So, we started out with this quote, and just to see how dynamic Nick is and this perseverance, it's just really phenomenal. And it just makes you think that not only if you want change, do you have to grab it, do you have to create it, but that you have to do it in full belief of the success that you can have and your ability to achieve the goals, to set out these not only just big, hairy, audacious goals, but life-changing goals. Megan and I do this not just because we love the transaction. It is not about loans for me, and it's not about closings for her. It is the vehicle in which we serve our clients and humanity reach more opportunity through the financial stability that only real estate gives you. And I know so many people are having this conversation around a housing recession right now, and I'm going to land this presentation with that. because I'm going to give you some quotes that you can then post on your social media. And if you could tag me, that would be awesome as we continue to build this movement together. That's the goal as we continue to serve and even go nationwide with this new venture. It is a joint venture. It is something that I will have a major ownership in, which is exciting. And you know me, the passion is going to be in the service of the company. And we're going to create that culture of full service for our clients, much like I experienced and then continue to grow through. So as we do this, you have to be willing to put it all on the line to achieve greatness, to achieve great things in the honor of serving. So let's jump in. First thing first, we are dang near out of space. We're coming up on our September Agent Ignite. I cannot wait to have Patty join us. She's going to be with us the whole 2 hours. If you come in person, you'll see 9 to 10, you'll see Patty. And then 10 to 11, Megan and I will jump on stage. I'm thinking Patty's going to also interject. I hope she does. And then we'll do our market update for those folks that can't make it in person that are going to watch us on Zoom or on live Facebook. So make sure that one or the other, if you want to come join us live, the breakfast is just going to be a small finger foods type breakfast, really just enjoying the space, and it's over by the Denver Broncos Stadium. So very excited about that. Make sure to RSVP. We have very, very few seats left. We are overfilling just a little bit, considering some of you won't show, but please don't do that. I want everybody that RSVPs to show because we're selling out seats. All right, so what's going on? We just flipped the calendar. The very first thing that I wanted to talk about is what's happening with rates. Holy moly. We have not had a good August. We had a really fantastic July after a ball busting June. And so July was really fantastic. We had some great, we were like screaming. I was on social, I was texting people, I was telling everybody, lock now. We've got 4.99, we have 4.5, we have these rates that we haven't seen in a while. And then, that went away. August went and just smacked the crumb out of our 10-year bonds and our interest rates. So we see this, I boxed out August. We have seen this going up mostly the entire month. The 10-year right now is at 3.28. We have broken through several trend lines. We are on our way to 3.5. It really is going to depend on how the job numbers come out tomorrow. Unemployment and job numbers come out tomorrow. Market trends for DMAR comes out on Saturday morning. So Saturday morning, where I usually rant a little bit about the economy, we're going to have all of our contact information for OneTrust and a little bit more about the company. And of course, we'll send out that report. So you'll have Megan's amazing data and then some shareables from the DMAR Market Trends report on Saturday. So just, oh my gosh, what a wealth of information that you can use going into Labor Day to really support your clients. Take advantage of this niche in time. It's not perfect. Nothing has been perfect since March of 2020. It is not perfect. Stop trying to make it perfect. It's just, I have an opportunity to get in as a buyer because it's a holiday weekend, because interest rates are high and it's scaring away other buyers. And because I was reading something yesterday and it was a listing agent and they're like, I know it's changed because I just got 37 items on the inspection request. Yeah, you're going to be asked for everything the buyer wants. If they're having to pay this higher payment with these higher interest rates, they want those things fixed because their payment just went up several $100s. So they need those things that they hadn't asked for before. So we could either go up towards 3.5 or we could come down towards 3. It depends on what happens tomorrow. So definitely watch for that. I'll probably have a little plug for that in our Saturday as well. So the interest rates have gone up right here, given, am I moving my slides, Miss Megan, on Facebook? Okay, just making sure. Since I'm working from home, it's just different technology. So we saw the interest rates throughout August go up. So just most recently, they're heading back to the 6 range. We're trying to be as competitive as we can with all lenders are trying to be as competitive as they possibly can. They know the shock factor of what's happening right now, but realistically, we're at 6. Now this yellow line Right here is the Freddie Mac numbers. And remember, those always have discount points. So those are 0.8 to 1% in discount points. It will always be lower than the rest of the trend line, but it's the one that the news picks up. So when the news says that we're at like 5.5, 5.625, we're really closer to 6 if you don't want to buy it down. So it just depends. And I wouldn't spend a whole lot of money on a rate buy down unless you need the numbers to work right today. Because we'll very probably have an opportunity to refinance and you don't want to waste your money doing the buy down. So Jackson Hole annual retreat, this is actually a slide from last week's presentation. As we were ramping up, I was telling you what to expect. Well, I want to tell you what happened. So what happened? They had 8 minutes of conversation. So he did not go into a lot of detail, but my gosh, his words were impactful on the market. His words were deep and they cut. So what were some of those words that we got during that brief period of time together? So Powell, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain. And if you read my Saturday blog based on this, I was like, this kind of reminds me of the sugar temper tantrum that your child goes through because you've been feeding them Tootsie Rolls for the last hour because you had to get through that conference call, and now you got to tame them because they're off the walls. This is that. This is that. The Fed, I don't want to say that the Fed is pushing us into this. We had supply chain. We had Russia. We now have China, who is back down into lockdown. I don't know if you guys saw that. A massive community, not all of China, a massive community is back under lockdown as of yesterday. So all of this is happening that has impacted supply chain and COVID and work from home. It is not all just the Fed. It is absolutely not. But the Fed did release a lot of liquidity, created an immense demand surge because all of a sudden people had money and cheap money. And so now they're pulling that away going, I'm so sorry. This is going to hurt. Right? And if you're in a self-employed and a household, you're doubly in pain. So here we go. So then we had a Fed member, so Powell Fed Chair, we had Fed member Loretta Messer come online yesterday, and she was talking about the fact that that she wants to see the Fed funds rate to go up to 4%. Remember, right now it's at like 2.75. She wants to see the Fed rate go up to 4% and then stay there. Powell said something similar, that we would want to have the higher Fed rates and then stay there for some longevity. They need to see that inflation actually taper down for a long period of time before they just go up and go back down. Powell was pretty clear on that, saying that don't get caught up in the fact that you might see a reversal, which goes into, does that mean that we're not going to see mortgage rates go down? The Fed rate does not equal the 30-year fixed, right? So it's not the same thing. So we got to separate those two. It's the impact that Fed rate has on inflation and opening up some of the supply chain deficiencies, getting that inventory to market, dropping down prices, that is also going to impact the 30-year fixed. So it's not just because one goes up, the other goes up, but we are expecting that to go up because they've got to really slam on the brakes and put that kid in time out. So she also goes on talking about she's expecting a fairly sharp slowdown in economic activity, i.e. recession. People are even talking about depression. I don't see anything like that. I'm going to show you some slides that you can use on social or with your client database that just continue to talk about the strength of what's happening with the economy right now. So as we look at where we're headed, we are trying to push towards understanding, right? I can't control the Fed rate. You can't control the Fed rate. You can't control where 30-year fixed interest rates are going, and you can't control the economic slowdown. But what you can control is the story, the positivity, the ability to support your clients through their own fear in heading towards the profitability and the opportunity that real estate gives. Staying positive and narrating a story that helps your clients reach home ownership is the goal that we are all trying to achieve. So let's keep going. So the PCE, what happened this week in some economic news? The PCE inflation came up for July. It happened right at the tail end of the month. And it actually dropped down just slightly, as you can kind of see this little dip down. It dropped down from a 6.8 to 6.3. Core went down just slightly as well, but it really kind of went up 0.1 where month over month, where the headline went down 0.1. So what happened there? So the headline includes gas and food. And gas was the primary driver of both of these numbers dropping, because now we're seeing gas around 4.25 versus, over $5, and even in some areas $6 a gallon. So that had a really big impact. Now the PCE is the Fed's preferred measure of inflation, whereas the CPI is the more consumer-centric measure of inflation, which takes a greater measure of household rent or mortgages, as well as healthcare costs. That's kind of excluded in some of this. So that's why it's always going to be lower than the CPI. What also came out? So Reuters came out with an article talking about what was happening, saying that the economy is still growing, slower, right? A little edgier, a little more stressful. The economy is still growing. So as we're looking at this and we're watching GDP, last week I talked about the fact that while the GDP, the second look, is still negative, it's less negative. It's actually improved by 0.3%. Still negative, but it's starting to creep up, and we're starting to see what is the rest of the year going to be. But the GDP is primarily based on consumer spending, and consumer spending was interestingly stable, not strong, and certainly not the heyday that we saw last year, but it was up 0.1%. We also saw manufacturing, really interesting. So we're in manufacturing, and we're actually in an expansion period still. So we are not in a contraction period. We're still above 50. We're at 52.8. And as you look at, they break down, what are the measures that go within that number? And we've got the overall manufacturer index is growing. New orders are growing. They were contracting, and now they're picking back up again. Production is growing. Employment is growing. There are still jobs to be had for those people looking for them. Inventory is growing. Consumer inventories are still too low, which means inventory will continue to grow and be able to support that. So all of that, this is good news. The bottom line, though, prices are still increasing. So this is talking about not at the retail, right? Because a lot of retailers are trying to reduce prices to bring in more demand. Now they're going to do that where they can, but the raw manufacturing, the shipping, all of that is still going up because we still have supply constraints in a lot of the market, but we're still growing. And this is good. Really interesting to me is that the consumer sentiment index went up. Like, that is jarringly up. So it actually went above 50 as well, showing that we're kind of in a feel good. We're in an expansionary period, but are we? So all they're doing is their future forecasting. So the biggest measure of this sentiment is, where do you think the economy will be a year from now? And that rose 13% just from last month. So, and 17%, it's still 17% below last year, but that was quite a jump. And that sentiment index is really just measuring the people that are going, I get that this is really hard, right? Like, I get that this is really hard, but I'm looking out a year out and I'm feeling like that's going to be good. It's going to be okay. We're going to be okay. We're going to go through a recession. We're going to go through a hard time. We're going to go through some pain, no doubt in my mind. But the anticipation that once we can control inflation, once we can open up the supply chain, once we can get to our next step, then we're going to be good. That is really good to see, because remember, those consumers are 2/3 of our GDP. And if they feel good, they'll keep spending even at a lower level, which will continue the prosperity of all markets, not just the residential market. ADP report came out. So we've been missing this ADP for the last 3 months. They were revising it, and it used to be based on models. Now it's no longer based on models, but based on 25 million jobs. So some really interesting information on this one. So it was up 132,000, which sounds really good. And it is really good. It's still, jobs are up. We're expecting 3,000 job increases tomorrow. When we get the unemployment number, we're expecting 3,000 job increases and an unemployment rate of 3.5%. So this ADP job number is saying that 132 new jobs. Now this is down. July was 380,000, and June was 380,000. July was 270, and now August is 132. So we are slowing down, just like everything else that we're seeing. We're still it's like appreciation. Appreciation is up, but it's just up less. right? So all of this, what is really interesting in all of this though, is the pay increases that they saw when they did these reports. The pay increase was 7.6% year over year for people who stayed at their job. 7.6%, and this is of the 25 million jobs that they actually went and got the detail for. This is no longer based on a survey. 25 million jobs, those job data is pulled in, saying that now we're seeing 7.6% for people who stayed at their job, 16.1% increase for pay for those people who went and found a new job. So those are the opportunities. People are still getting paid more. Yes, things cost more, but we have to remember that a lot of employers are trying to keep any labor that they can, other than those companies that are having to scale back that ramped up too much during COVID. So, and this is all Americans. If you strip out the bottom quartile, these numbers are even that much higher for your clients, for homeowners. We also had JOLTS, the jobless numbers came out, and job opening numbers. JOLTS is the job opening numbers. And so the job openings went up. Okay, that's weird. Why did it go up? You'd think that people are closing down jobs. We're going into a recession. So some of this has to do with the fact that now, because people work from home, they have job listings across the country, and there might be some multiples that are going into this job numbers going up. So I wouldn't read too much into that. But we are seeing that still, based on this, that we have 1.98 jobs per person. So, those people that need a job are finding them, which is just feeding into the fact that jobless claims is still staying low. Jobless claim total is the lowest level it's been in 2 months. People don't have to file for unemployment if they get laid off, because they can go find another job right away. This is the economics that will continue to support the spending that we're seeing and the ability to have buyers. People are still buying. Less people are buying, undoubtedly. I can't ignore that fact. I'd love to be the cheerleader that says that more people are buying. That would be lying. More people are not buying. But people are still buying. People are still having life events. First-time home buyers are jumping in, because we saw that last week that the FHA applications were up 4%. We're seeing that those buyers who are aware of what's happening are going ahead and taking those higher interest rates, knowing that the opportunity to refinance is still there. So mortgage purchase applications are down. They're down almost 2%, 1.8% week over week, and they're down 23% year over year. I got to go back to 2015 to see that number before. So demand is down, and this feeds into what I'm about to talk about with the housing recession. Consumer spending is also down. We just dropped just a hair if we look at those numbers. So construction spending is down. We know that. We already have talked about in the last couple of weeks about construction permits and starts, and really it's just completions that are up because they're rolling through the pipeline and getting those buyers to the closing table as fast as possible for any of those buyers that are still there that can afford that payment with the higher interest rate. So consumer spending is down, mortgage purchase applications are down, interest rates are up. That's not good, right? So does that mean a housing recession? So Lawrence Yun had said, in terms of economic impact, we're surely in a housing recession because builders are not building, right? It's primarily around the Builders Confidence Index. That's what kicked this off. That happened. And all of a sudden, the very same day, the Builder Confidence Index was crashingly low. And immediately everybody said, we're in a housing recession, because that same 50-line Building Confidence Index was below in a contracting environment. So saying the builders are not building, sales activities declined for 6 consecutive months, meaning economic activity has slowed. Now, Christine Cooper, the chief economist and managing director at CoStar, she says, but homes are still selling. Like, I get it. Building is down, but homes are still selling. The indicators may be grim, but to a large extent, the slowdown in the market is a reversion back towards a balanced market. We're not in a balanced market. Yes, it certainly feels like a buyer's market. It's not either of those things yet. It's just slowing down. So homes are still selling. The indicators might be grim, but we're still seeing this move back toward. Take advantage of this. Take advantage of the fact that you can have 15, 20, 30 inspection items on your inspection report, that you can negotiate the price when you put it under contract, that you can renegotiate based on it if appraisal goes down. But if I showed you guys last month, we had no low appraisals coming in here in the state of Colorado, which was absolutely fantastic. Homeowners are absolutely not in a recession. That's Lawrence Yun. Lawrence Yun but wait, but he just said that we're in a housing recession. And yes, he did, but he's saying homeowners, builders are having issue starting permits, having too much inventory, getting those buyers to the closing table. Builder confidence index is low. We just saw that the construction spending is down, interest rates are up, mortgage purchase applications are down. Yes, all of that is happening. Homeowners are not in a recession. They have the equity. For ordinary consumers, the word recession conjures up dismal times. It's a difficult market for those who are selling homes and for home builders. Those who are selling homes have to get realistic and price their home appropriately and stage it right. But homeowners continue to accumulate housing wealth from rising home prices. Rising home prices are still double digits. As of last month, they were still 11%. Now we'll be watching what they are this month. And I know Megan is constantly showing us where those median and average numbers are going. We'll watch where the appreciation numbers are going. CoreLogic and FHFA just came out, but their numbers were for June. I didn't even show them. They literally came out this week. They're not included in the presentation. They're June's numbers, which my mind is blown. I mean, June was so different from July, which was so different from August, that I used to be able to say that was a trend line, but right now it's not. But we are seeing that home prices and true home appreciation. And interestingly, in the FHFA, I guess the one thing I could have included is in the FHFA report, they were actually talking about, most of those are on purchases. So they're talking about, they're looking at purchase data when a contract is executed and that sale is recorded. What is that purchase data? FHFA pulled in the refinance data and really saw a push of values going up. So it's the homeowners who continue to accumulate wealth. Okay, but you got to become a homeowner to start building the wealth. You can't be sitting on the sidelines saying, woe is me, it's not happening for me, if I am not willing to take a little bit of risk and jump. The rewards come with the risk. Now, of course, it's how risk tolerant you are, how stable is your job, how much backup do you have in reserves. It's all those things that you should be talking about and realistically putting together a picture for your clients, not just simply saying it's really scary out there. It's like really scary out there, right? Because every article you're reading is talking about a housing recession. So yes, put it into perspective. Homeowners are absolutely not in a recession, but you've got to become one because the alternative is still renting and it's still going up. Apartment List just came out with their report. Nationwide rents are up 10%. Colorado rents are up 7.3%. Arvada is crushing it. They're up 7.8%. And I say that from the perspective of the landlord. That is not the perspective that you want to hear from the tenant. Right? But you've got to jump. You've got to have the conversation about where the economy is really going. And if this really, to see the consumer sentiment index go up as much as it did, when they're looking out a year out, means how long are we going to be here? There will be pain. But how long will that pain have to be endured? Am I stable enough to endure it? Right? And then can I put a foot in and start to walk towards or leap into home ownership so that when that turns around and demand comes back because interest rates drop, I'm on the homeowner side and not on the renter side. Because as homeowners start building up homes again, those investments have to turn into higher rental rates. And so we're going to continue to see rental rates go up, maybe not at the extremes, but they're going to continue to go up. All across Colorado, we saw rents increase. I mean, Parker, the per month rent on Parker kind of tipped the scales, but it wasn't the highest. Aurora was the highest year over year rent growth, but we're all doing really well for our landlords. Our tenants are suffering and we have to keep talking to them because landlords might not want to renew. They might want to sell and take their equity off the table, or they might want to not renew so they can get that higher rent. That rental, although you are securely in that rental for that period of time, whether it's a year, 6 months, or 2 years, there's no guarantee after that. What does that life look like? If I just add that monthly payment on now and I absorb it, and then I overcome it, and then I refinance it, we're talking about opportunity, but it has to be presented in a way that it's strategy, it's longevity, and it's created with a plan in place. Don't do something just to do it. You do it because it makes sense long-term. Real estate is not like going to the grocery store and buying bread. This is a long-term planned out event, and it should be treated as such and negate all the stuff that's in the news and look at the opportunities from a reality perspective. And the reality is it's not all sunshine and puppies, but it is solid, but it is good, right? It's not great. It's not awful, but it is stressful. And those home buyers are having a hard time. But our vacancy index is still low. If I even go back to 2019, we had an average of just under 7% vacancy rate for apartments. Now we're at 5%. So to see that vacancy rate is still low means that we're going to continue to see these rents go up. It's not going to just turn right around. I'm seeing a lot of condominiums for rent. I live right by the DU area, and I'm seeing a ton of new builds, and they're all for rent, right? They're all for rent. They're just gobbling up these rental incomes. You're seeing it downtown. You're seeing a ton of rental properties being built, but they're being built up. If you're looking for opportunities, buy something with a little piece of land, buy something that has a backyard, buy something where Coloradoans who love their dogs can spend their time, because that's where the real opportunity is. And if you want, we did move the date. So this month, Building an Investment Empire is on a Tuesday. It's in 2 weeks, and we'll send out information about that too. If you want to look at how do I look at this as an opportunity, not as a burden, that's what we're going to continue to talk about. All of our classes are continuing, and we're still continuing to drive for excellence in our realtor and in our buyer education. So our last bit, so rising interest rates. So this little chart, last week I gave you a chart showing the principal and interest based on the purchase price and the interest rates. Really nice takeaway for any of those that grabbed it. We uploaded it to the Agent Ignite Facebook group. If you are not a member, you need to become one. That's where we put all of our videos and our all of our slides are uploaded, and great tools like this. So we'll upload this as well. Create little chart to say, hey, in $100,000 increments. So if I'm buying if I'm getting a $400,000 loan or $600,000 loan or $700,000 loan, this is the PI payment based on increments. And that difference column is just really from the 4%. So as we're seeing those interest rates go up, those payments are going up, and we're seeing them go up right now. And depending on what happens tomorrow, it could be really good or really bad. Like, I'm just going to say it, right? Like, we could go up to 3.5, which means our interest rates are going to go hit 6% or a little bit over again, or it could come down to 3 to 3.25. So watching what the jobs numbers do will be really important. And we'll probably even do a quick live as soon as they come out, telling you what to worry about going into Labor Day weekend if you have buyers going out. So watch for that. And then the last thing, the next big thing is cranking. We just got it finalized. We have one more speaker we're talking to, but we have a full lineup. We've got agents coming in from around the country talking about what their next big thing, how they're building their business. They're talking about their insights. The website is up. We have all the speakers up, and now we're starting to solicit sponsors. We've had a fantastic turnout for sponsors already. This is a one-day event. I know that the 2 days was a big commitment last year. We're going to try it both ways and see which way everybody likes better. And it's right downtown. It's so easy for you guys. It's not way up in the boonies. Drive into it last year, I felt like I was entering Kansas. My teammates fun of me all the time. I have a very small bubble. So this is downtown, and the valet is included. So make sure to reach out to me if your company or your team. I've got some brokerages that are sponsoring. If you guys want to sponsor, we've got a list of things that we can do that with. All right, I'm going to stop my share.
Awesome. Well done, as always. Even with all of the shifts and changes that you have going on this week, you still managed to get through it. It's amazing.
Nice. Yes.
So thanks everyone for joining us. It looks like we had one question just pop up.
Yes.
Questions pop up. What is the name of the Facebook group?
It is Agent Ignite, and there's an Agent Ignite Facebook page, which is very inactive. So it's the Facebook Ignite group, or I'm sorry, the Agent Ignite group.
Awesome.
Yes.
And so that's answered. Nicole, sellers paying for interest buy down versus lowering their price is a bigger benefit for buyers, correct?
That
the
is
challenge in MLS does not push up updates on seller incentives only for price change. Do you have suggestions besides e-flyers to increase buyer interest with seller incentives?
Drop the price 50 bucks. I mean, send it out, add the notes, highlight the seller buy down. You're absolutely right. That pay down on the regular interest rates is going to impact you more because right now there's not a good secondary market for interest rates. So they're very flat. To buy down, you have to spend a lot of money to get it down significantly, versus this kind of 2-1 buy down allows you to really jump 1 to 2 points and have that monthly payment reduced right away.
Awesome. And then one follow-up question, how does a seller incentive interest rate buy down work if we partnered with you and the buyer already has a lender?
You can only do it with the lender. So it is part of the lender package to do the 2-1 buy down. Sorry about that.
Awesome. Cool. Well, thanks so much for tuning in, guys. That takes us right to 11 o'clock. As a reminder, we'll be following up with an email that includes the recording from today, registration for the rest of September. We are skipping next week, so please don't forget there will be no webinar next week. We've got some time off that is on our books, and so we won't be doing it next week, but we'll return the week thereafter. So make sure that you get registered. When you register for these events, you can register for the entire month of September all at once so that you're not having to get the reminder every week. Even though I do send out the reminder every week, I just want to make sure that you can go ahead and sign up all in one fell swoop. And of course, we'll send out our slide deck. And if you're not registered for my class, or you're automatically registered to receive the reports going forward. So no need to reach out to me, and I will follow up with you, as will Nicole. So thanks so much for tuning in, guys. We hope that if we're able to help you better advise your buyers and sellers, that we'll have an opportunity to work with them. Our job is to be of servant hearts and to make sure that we're doing our part to make you successful. And we hope that if we're able to help you be more successful, that you'll in turn help us be more successful too. So please consider First American Title and Nicole Ruth with the Ruth team for your upcoming transactions. And we will see you guys soon. Have a great weekend.
Happy Labor Day.